Hello and assalamu alaikum everyone. I'm Kashif Kamran, the AAA expert tutor, and today we have something very important on agenda. I'm discussing the IFRS 18 presentation and disclosure in the financial statement, not just taking a quick glance of the standard, but also guiding you about the impact on the AAA paper. Now, being the AAA tutor, it is very important that I'll guide you the likely impact of this standard on your upcoming exam setting. And we know IFRS 18 is applicable from September 2025 exam setting. Let's open up the discussion. Let's first take a quick glance at IFRS 18 just to understand some of the fundamentals. Number one, about IFRS 18. The IFRS 18 replaces IAS 1 and responds to investor demand for better information about companies' financial performance. So more clarity, more transparency, that was the demand of the investor. They want to see a more structured statement of profit or loss so that they can take more wise decisions. And that's exactly what IFRS 18 has done in. We'll see the changes. The new requirement includes new categories and subtotals. That's number one. Disclosure of MPM, which is management defined performance measure. That's number two. We'll see what they are. And number three is enhanced requirements on grouping information. So three important things which has been done under IFRS 18. Number one is the new categories and subtotals in the statement of profit and loss. Number two is the MPM disclosures. And number three is the grouping of information. Now, in terms of the more important feature of IFRS 18 is that IFRS 18 now requires to classify all items of income and expenses into five categories, namely operating, investing, financing, income taxes, and discontinued operation. The first three categories are new. So the operating category, the finance investing category, and the financing categories are new. The income tax category or the discontinued operation used to be even before in IAS 1. So five categorizations of income and expenses. So that will give a more proper presentation of your statement of profit and loss. So the shareholders will have a more clear perspective of your operating side, of your investing side, of your financing side, of your income tax side, and if any discontinued operation. So they will look into different sections of the statement of profit and loss and will give them a better decision-making power. IFRS 18 provides specific guidance to assist the preparers in identifying items to be classified in each respective category. So how would you categorize into each of the category? How would you classify the items of income and expenses in each of the categories? So IFRS 18 has given us guidance about that specifically for companies whose main business activity is investing into assets or providing finance to customer, like the banking companies, right? Like the banks. Now, for banks, providing finance to customer is their main activity. So, providing finance to customers, the companies, they would be treating for the normal companies. For the normal companies, what is investing or what is financing? For a banking company, that will be the operating activities. The categories are complemented by the requirement to present subtotals and totals for operating profit or loss. So you have to give a total for operating profit or loss before financing and income taxes, and finally, the profit for the year or profit or loss for the year. So these are three new subtotals to come on your statement of profit and or loss: operating profit or loss, profit before financing and income taxes, and the profit. The profit means the profit for the year before the discontinued operation or profit from your normal business. Now, look at this. The categories and the subtotals in the profit or loss. Now, IFRS 18 has introduced three new defined categories Number one, the operating category. Number two, the investing category. And number three, the financing category. Two new required subtotals. Number one subtotal is the operating profit. So after the gross profit, you will see the operating profit. And then another subtotal, which is the profit before financing and income taxes. I'll just show you the layout and you will be better off looking at the layout. So five categories. Three are new categories: operating, investing, financing. But if you look at the five categories, it includes income taxes and discontinued operation. Uh, Two new subtotals. Number one subtotal is the operating profit, and number two subtotal is the profit before financing and income taxes. So this is how the structural changes have come to the statement of profit or loss. Look at this picture in front of your screen on the right hand side, gives you a realistic idea of how things would be. Revenue, cost of sales, and you get to the gross profit. Now, after the gross profit, you have the operating income and the operating expenses, like other operating income. Then you have selling expense, research and development expense, journal administrative expenses, goodwill impairment loss, and other operating expenses. Then you get down to operating profit. So after the gross profit, you had the other operating income. And after the other operating income, you have all the types of expenses, and you're coming down to the operating profit. Well, we'll see with clarity the use of the word other, and is IFRS 18 encouraging to use the word other or not, and in what context you can use the word other in IFRS 18. So we have this word over here, other operating income, and we have this word over here, other operating expenses. But beside that, you can see that expenses have been disaggregated. They have been presented uh, as separately as possible. You're not grouping them or you're not aggregating them unless and until they have shared characteristics. We'll come to that shortly, but you need to disintegrate. Look at this expense. Goodwill impairment loss has been given separately, or impairment loss, give it separately. You cannot club the impairment loss into administrative expenses. So try to disaggregate expenses where possible if they don't have the shared characteristics with other expenses. Otherwise, you can have a category of administrative expenses. If you believe a lot of expenses have the shared characteristic, you can bring them under journal and administrative expenses. But if there are any specific expenses which can't be grouped together, then present them separately. We'll come to that context later. But look at the operating side now. So from the revenue here to the operating profit, this is all the operating category. Then after the operating category, you have the investing section where you are putting the share of profit or loss from associate or share of profit or loss from joint venture as a separate line item. Then you have other investment income, even like the gain on the fair value of the investment property can come here as a separate line item because that's part of your investing activity. For normal entities, we're not talking about the banking operations, etc. So investing activities coming in. Then you have the profit before financing and income tax. Now look at these two subtotals in blue. These are new subtotals, right? Operating profit is a new subtotal number one, and profit before financing and income taxes is a new subtotal number two. Now, then you have your interest expenses on borrowings and lease liability. Then you have interest expenses on pension liability and provisions. That's part of your financing. And then you get to profit before income tax. That's number three. Minus the income tax, you get to the profit. Now, this is a profit before the discontinued operation. If you have any discontinued operation, you will get after that, and you will mention the profit or loss from the discontinued operation, and then you will get another profit number. We'll go to that larger exercise shortly. But look at this. This is what you need to remember as a AAA student for the statement of profit and loss. You have a revenue, you have a cost of sale, you have a gross profit. Then you have operating income and operating expenses coming in. Try to disaggregate expenses where possible if they don't share any shared characteristics. Then you have your operating profit. That's the new subtotal. And after operating profit, you have your investing category coming in. So anything falling under investing would go there. And then you have the profit uh, before financing and income taxes. Then you have all sort of financing activities coming in. And then you have the profit before income tax. Finally, the income tax and the profit. Now, this is a more structured approach, which is fulfilling the need of the investor. This is what investor uh, was looking for, and that's what IFRS 18 has done. So subtotals, operating profit, profit before financing and income taxes. So they exactly know how much profit the business is generating from its operation, how much profit the business is generating from before financing and income taxes, and then how much profit have they generated before income taxes, and then finally what's the profit for the year. So they will get different versions of profit on whichever they want to base their decision on. So that's number one thing, right? Now, requirement for specific companies. Number one, for some companies, financing and investing activities are their main business activities. For example, the banks and insurers. So banks and insurers, the financing and investing activities are their operating activities. So they would classify them under operating activities. Those companies include income and expenses in their operating profit that for the other companies would be included in investing or financing category. I hope you're getting this point, right? So banks and insurance companies. So for them, the income and expenses in the operating profit would would be like the investing and financing categories for the other companies. Because for them, the investing and financing is the main business, right? So the main business will go into the operating side, which for the other companies is basically investing or financing. I hope that's clear for you, right? So banks and insurance companies will behave differently. Disclosures for MPMs, management defined performance measures. Now, this is the second thing we are starting. The first thing was the categories and the subtotals. Now we have different categories in the statement of profit and loss, and we have different subtotals in the statement of profit and loss. I've just given you a glimpse of that. And particularly for companies like banks and insurance companies, for them, what is financing and investing for other companies would be classified for them as operating activities because that's their nature of business. The second thing important from IFRS 18 is the disclosures of MPMs. Disclosure means in the notes to the financial statement, right? IFRS 18 introduce requirements to disclose in a single note. So you have to disclose in a single note. Now that means a note in the financial statement. A single note will be given for the management defined performance measures. You can give a heading MPMs in that particular note number, any note number in your financial statement like 20, 25, 26, whatever. And you give a disclosure of your MPMs there. Now, what basically are MPMs and what's the need? Let's understand this. Look at this slide for the understanding of MPMs. Another important feature of the new standard is the management defined performance measures. And an MPM is a subtotal of income and expenses not listed in IFRS accounting standards, nor specifically required to be presented or disclosed by IFRS. It's a subtotal or it's a total of your income and expenses, which is presented differently for the purpose of management, for the purpose of management defined performance measures, which is not required by IFRS and not anywhere mentioned in IFRS. So you're doing it on your own as management. So on the face of the statement of profit or loss, you have your categories. On the face of the statement of profit and loss, you have the subtotals like operating profit. You have the subtotals like profit before financing and income taxes. Now that is mandated by IFRS 18. But if you want to present some different subtotals, you want to present results in a bit different manner, you will take them to MPMs. You will disclose them in MPMs in the note numbers, but they're not required by IFRS 18. Let's take an example. We know lots of companies give IB give the earning before interest and taxes, depreciation and amortization. How many times the company use this as their performance measure? We have seen so many times the company measures their performance on the basis of on the basis of the EBITDA, earning before interest, tax, depreciation, and amortization. Now, this is not required on the statement of profit or loss, because on the statement of profit and loss, you're giving only the operating profit or the profit before financing and income taxes. So in the note number, you can make a revised figure from the totals and subtotals of the profit and loss, and you can do a working for EBITDA, and you can mention that this is one of our performance measure, and what purpose you want to achieve from EBITDA and why you do it. You will tell shareholders about that. Why you believe this EBITDA is a management defined performance measure, and how you measure companies' performance more realistically through this performance measure, and why there is a need for so. So you will give a disclosure of this, right? Now look at this number. EBITDA. Has this been derived from the numbers given in the P&L? Yes. Has this been extracted from the numbers given in P&L? So you will do a reconciliation as well, right? You will tell, okay, this is the operating profit, and I've added this, I've minus this, and this is how I came to the earning before interest, income taxes, depreciation, and amortization. Sorry, interest, taxes, depreciation, and amortization. ITDA. So I is the interest, sorry. T is the tax, D is the depreciation, and A is the amortization. And a lot of time the companies give something like this: OPDAI, operating profit before depreciation, amortization, and impairment losses. I is impairment. In this OPDI, this I is basically impairment, right? This is impairment. So a lot of time the companies use different performance measures which are different from the subtotals given on the profit or loss. But management needs to justify that what benefit they get from these MPMs. How do they realistically measure performance of the company using these MPMs on your screen as examples? So if you want to do this, you will give the disclosures of these MPMs not required by IFRS into the notes to the financial statement. And you will do the reconciliation of OPDAI with your operating profit or profit before income taxes. So you have to show the reconciliation, right? How you got to this number of OPDAI, or how you got to this number of EBITDA. Is everyone clear on this? Is everyone clear on the management defined performance measures? So sometimes the management has to give their performance measures which are different from the totals given on the statement of profit and loss. The IFRS 18 is saying, yes, you can give it, but into the note numbers and mention a reconciliation of how you got these numbers, right? So this is how things should be in MPM. Now, to me, I don't see any impact of this immediately on the AAA exam paper. But yes, on the safe side, you should know that MPMs are part of IFRS 18. A separate disclosure is required in the notes to the financial statement, and the management needs to justify why they need these MPMs, and the management needs to give a reconciliation of these MPMs back to the statement of profit and loss. If you can see this over here, look at this. You need to give this. You will give a reconciliation of your management defined performance measure in the notes back to the IFRS defined subtotals, right? Number one. Number two, why you need these MPMs to be reported, you will justify that. How the MPM is calculated. So you will also tell the shareholders how have we calculated like OPDAI, reconciliation of the OPDAI to the totals in the statement of profit and loss, why we need the OPDAI, and explanation of any changes to the MPM. Have you done any changes to MPM from the last year? For example, last year you were giving OPDAI, and this year you have started to give the earning before interest, taxes, depreciation, and amortization. Why have you changed? So this is all what will go into the note number in the financial statement. So this is important slide in front of you, right? About the disclosures for MPM. And this particular slide is telling you examples of MPMs to understand it more realistically. So is everyone clear now with the two changes in IFRS 18? Number one is the categories: operating, investing, financing, income taxes, and discontinued operation. Uh, the further aspect of number one is the subtotals for operating profit, and the subtotals for profit before financing and income taxes. Number two is the disclosure of the MPMs. I hope you're all clear till now. Now, moving further, aggregations and disaggregation of information. IFRS 18 has introduced enhanced requirement for grouping of information, including requirement for presenting and disclosing operating expenses, guidance on whether information should be in the primary financial statement or notes, and disclosure about items labeled as others. Can we label items as others, like other income, other expenses? We'll see guidance of IFRS 18 on that. Number two, uh, enhanced requirement for grouping of information. In what context can we group information, like administrative expenses? Now, administrative expenses is a group. Should we give a breakup of administrative expenses in the notes to the account? Because it's written over here, guidance on whether information should be in the primary financial statement or in the notes. So if we group something on the face of the statement of profit or loss, should we disintegrate that in the notes? So the shareholder would know what comes under administrative expenses. In what context can we group an expense? In what context can we group an income? And can we label an item as other? Let's find a clarity on aggregating something or disaggregating something in the statement of profit or loss. Look at this. Number one, for example, an entity might have various activities like human resource activity, like information technology activity, like a legal activity, or like an accounting activity. They have shared characteristics and so might be aggregated into a single line in the statement of profit or loss and labeled as administrative expenses. A lot of expenses of human resource, information technology, legal, and accounting might be very similar. So you might club them under as administrative expenses and label them as administrative expenses in the statement on profit and loss. If you want to give any further breakup of administrative expenses, you can give that in the note numbers. But over here, IFRS is saying that if you have shared characteristics of expenses, you can club them and put them under administrative expenses. Number two, a goodwill impairment loss or a goodwill impairment does not share characteristics with human resource, information technology, legal, and accounting cost included within the administrative expense. And so aggregating it with these in administrative expenses will not be appropriate. So like impairment loss or goodwill impairment loss, you cannot just club them under administrative expenses because they don't have shared characteristics. So any expenses having shared characteristics can be grouped, can be aggregated. Otherwise, you have to disintegrate or disaggregate those expenses and present them separately, just like an example of the impairment loss or the goodwill impairment loss should be presented separately. Is everyone clear about aggregations and disaggregations? And we saw this at the beginning of the session today. Look at this. Like we saw goodwill impairment loss coming here as separately. Then we had other operating expenses. We had journal and administrative expenses. Look at this research and development expense given separately. Selling expense given separately. So wherever possible and wherever you believe that the expense is not having any shared characteristic with another expense, give it separately. Wherever you believe an expense has a shared characteristic with another expense, club them together. Now look at the screen in front of you. Selling expense has been given disaggregatedly. Research and development expense disaggregatedly. Journal and administrative expenses aggregatedly. Goodwill impairment loss disaggregatedly. Other operating expenses aggregatedly. So where possible, try to differentiate between aggregations and disaggregation, because shareholder would love to see the split of different expenses coming on the face of the profit or loss. Is that clear to all of you? Are you all sound with the groupings? You're all sound with aggregations and disaggregation of information? Now let's find the conclusion for others. Can we label others in under the IFRS 18? Is IFRS 18 encouraging others or not? Others are discouraged broadly by IFRS 18. IFRS 18 discourage entities from labeling items as others, requiring them to determine whether a more informative label exists. Additional disclosures apply for items labeled as others. But if you still label an item as other because you believe I don't have any appropriate label beside other. So you think of another label for others. But if you think I don't have any other label for others, I would still label them as others. You need to give additional disclosures. For example, you say other income, then in the notes to the account, you will give the breakup of other income, what's coming in it. Or you say other expenses, then in the notes to the account, you will give the breakup of other expenses. Is that clear? But at the first go, try to find a suitable label for others. Is that clear? Try to find a suitable label for others. But if you fail to find so, and you still use the word others, then try to not try, give a breakup of that in the notes to the financial statement. Is that clear to all of you? So just let's do a quick recap of IFRS 18 before we jump into the AAA. Now, what's the recap of IFRS 18? Number one, and I hope we're all clear on that. Let's look into this. Look at the bullet number 2. New requirements includes new categories. Have we covered the new categories? How many categories we have in IFRS 18 now? How many categories we have in IFRS 18? A total of 5 categories, right? Operating, investing, financing, income tax, and discontinued operation, right? Okay, then we have the subtotals. How many new subtotals we have in IFRS 18? How many new subtotals we have in IFRS 18? We have 2 new subtotals. One is the operating profit and one is the profit before financing and income taxes. These are 2 new subtotals. Number 3, disclosure of MPMs. Are you clear about the disclosure of MPMs? Are MPMs required by IFRS 18? No. But can the management give them separately in the notes? Yes. But if the management is giving an MPM in the notes, they will justify why. They will show the working of MPM. They will do a reconciliation of MPM with the IFRS totals. And if there is any change in the MPM from the last year, for example, last year you were using OPDAI, and this year you are using the EBITDA, you will justify why. So everyone should be clear about the disclosure needs of MPM. And finally, are you all clear on aggregation and disaggregation of income and expenses? To, to, to whatever extent possible, try to disaggregate them. And if you're aggregating them, you should give a breakup of that in the notes. And if you're using the word others, though IFRS 18 discourage that, but if you're still using the word other, try to give a disclosure of that in the notes to the financial statement. Is everyone clear now with IFRS 18? Please ensure there are 2 articles on IFRS 18 available on the ACCA websites. One relates with the one on your screen now. I hope you can see this article in front of your screen. This one, sorry. Can you see this article on your screen right over here? This is from the SPR examining team. IFRS 18 presentation and disclosure in the financial statement. I'll share this with you. You can go to the SPR technical articles, and from the SPR technical articles, you can download this article, IFRS 18 disclosure in the financial statement. Read through this. It's a wonderful article, and it will give you about all what we have discussed today, the 5 categories on your screen. It will give you examples of each category, so that could be beneficial for your exam paper. Then it's also telling you about the aggregations and disaggregations. It's also telling you about the MPMs as well. They have also given you a complete looking profit or loss on your screen. You can see it right over here. See right here, they've also shown income taxes, then profit from continuing operation. So if you have a discontinued operation, then after you deduct the income taxes, you will say profit from the continuing operation. Then loss from discontinued operation minus, then you say profit. So finally, the word profit will come after discontinued operation. But if you don't have discontinued operation, then when you deduct the income taxes from here, 145, you will directly use the word profit. So profit or loss will come directly after income taxes. But if you have a discontinued operation, then you will use the word profit right after discontinued operation. So again, this is another example in the SPR technical article, operating, investing, financing, income taxes, and discontinued operation. Please ensure you go through this performer. And then they're giving us about aggregations and disaggregations. Should we do aggregations and disaggregation? You can read through this. I've taken the same example from here in my presentation today. So it's a good article. After my presentation today, if you read through it, you will better be well versed with your upcoming September 25 paper. They're also giving us about MPMs and examples of MPMs. If you've understood my presentation, that's well. Otherwise, you can go from this part more effectively. So this is one recommendable article on your screen. Okay, now just let's get back to the important phase of our discussion. Now comes the phase which for all of you is important. And that's the phase where we are talking about the IFRS 18 impact on AAA. So far, we just took a quick glance. It was just a knowledge area, just to understand IFRS 18, just to understand the fundamental changes in IFRS 18. Not just let's understand the impact on AAA. How would it impact your September 25 exams onwards? What sort of fundamental changes you can see in the question number 1, 2, or 3? Let's be realistic about that, because there is a lot of hypothetical assumptions going among the AAA student community, and lots of WhatsApp groups I am in. I'm seeing some very strange questions of students around IFRS 18. First of all, you need to ask a question to yourself. How much time you used to see IAS 1 in your previous AAA versions? Accounting standard comes a lot in AAA, particularly if you get a question on audit risk and risk of material misstatement, or particularly you get a question on audit report or evidences. You need to write about accounting treatments. But how many times have you wrote about IAS 1? How frequently IAS 1 used to come in your exams? So in that context, realistically think about the impact the IFRS 18 will have on your AAA. Just let's open up the discussion. Number one, determination of materiality in the AAA paper. Now, we know one of the factor on which you determine materiality in the AAA paper is known as profit before tax. Now, the terminology will change. It will no more be profit before tax. It will be profit before income taxes. If you have seen the mock exam, September 25 mock exam, in the partner email of the question number 1, I'll show you that. The partner is saying you should determine the materiality on profit before income taxes. See the change of terminology? Now, what is the right terminology to use in an exam? Even when you're writing the answer, you will not say profit before tax. You will say profit before income taxes. So be very sure of that. Just let me show you that quickly. If you go to the practice platform, can you see the mock exam in front of you, all of you? Can you see the AAA September 25 mock exam on your screens? Please confirm me that. Okay, thank you so much for that confirmation. Now, in the mock exam, when you open up the partner email, now this is the question number one, and we're seeing the realistic impact of IFRS 18 on your question number one. You open the question number one and you look at the partner email. Now, in the partner email, we know this paragraph which says, hello, do tell us the factor on which to base the materiality on, right? Now, look at this, what the partner is saying over here. Look at this one. Look at this line. I'm just highlighting this in yellow. Based on the analysis I have done on this industry, I have decided to use profit before income taxes as the basis of determining my materiality. What was the old terminology? The old terminology was profit before tax. Now the new terminology is profit before income tax. So please be habitual of using the new jargons so that the AAA examining team checking your paper knows that you're well versed with the new jargons. Rather than saying profit, think about which profit am I talking about? Operating profit? Or am I talking about the profit before financing and income taxes? When you're writing about materiality, uh, please don't say profit before tax, say profit before income tax. 5 to 10% of the profit before income tax. And see, that's been clearly used in the partner email. Are you all clear? Look at this. Uh, the financial information. You know we get a financial information in the question number one, an extract of the financial information, all of you. So we do get some selected financial numbers in the question number one. That's quite a routine part. In the mock exam, we have the selected financial numbers. Revenue. Right after revenue, see what have they given here? Profit before income taxes. So they have changed the terminology even in the mock exam to reflect IFRS 18. Then rest is all the same, total assets, the number of leisure clubs and the number of members. So we have selected financial information. So in the September 25 exam, we might have operating profit given. We might have profit before financing and income tax given. We might have, we will be given the profit before income taxes because that's the determination of materiality. So the subtotals that will be given to you in September 25 exams will reflect the subtotals of IFRS 18, like operating profit, profit before financing and income taxes, or they might give you a subtotal of like profit, and definitely they will give you a subtotal of profit before income taxes because that's where the determination of materiality comes in. So number one is the change of terminology. You have to be very well versed with that. Now, when you say the profit is understated, how many times you use this word profit is overstated or profit is understated in the AAA paper? Whenever we're writing the audit risk answer, or we're writing the ROM answer, or we're writing the answer for reporting, or we're writing the answer for evidences. How many times you use this word expenses understated, profit overstated, or expenses overstated, profit understated? How many times you write these words in a prior attempts of the paper? Tell me. Is that something routine in the AAA paper? Expenses overstated, expenses understated, profit overstated, profit understated. Do we use these terminologies in writing answers? Tell me, everyone. We do, right? Now, when we are saying profit understated and profit overstated, should we be careful? Which profit? If you are an intelligent student, you might say operating profit. Or you think about, no, this is after the investing activity. So it's the profit before financing and income, profit before financing and income tax has been under or overstated. Now there are different categories of profits: gross profit, operating profit, profit before financing and income taxes. So be very particular. Rather than just using the word profit, use the proper word of IFRS 18 so to impress your marker. Is that clear to all of you? Before we speak of more changes in how it impacts the AAA. So first is the materiality threshold, revenue, total assets. Now the third one is profit before income taxes. Please use the proper terminology. Is everyone clear on that? Okay. Secondly, when you use the word profit is understated and profit is overstated, be very realistic that you're using the right term for profit. Okay. I will show you a good answer, which I've written for you. How terminologies change will impact your answer just in 5 minutes. Okay, number two, look at the change of terminologies quickly. On the left side, this is the current. On the right side, it is the new. New means IFRS 18. Current, we say profit before income taxes. Now the new is operating profit. So profit before income tax would now change to a new terminology known as operating profit. Distribution cost is now known as a selling expenses. So in the exam, if you're saying distribution cost, please refrain from that because the new terminology under IFRS 18 is selling expenses. And that's what we saw in the performer as well. Finance charges have now become interest cost. So please don't say the finance charges are understated or finance charges are overstated or management would have calculated the finance charges wrongly. The right terminology is interest cost. Please be careful about that. Profit before tax will now become profit before income tax, and profit after tax will become profit for the year. So look at the right column. That's the terminologies you have to use in your exam. If you mistakenly use the terminology finance charge or you mistakenly use the terminology profit before tax, it will not be wrong, but you're losing your professional skill marks because a AAA student should be very well versed in IFRS 18. So please follow the change of terminologies. Next, the mock exam. Let's show you something from the mock exam. I've compiled an answer, even though I will be doing a mock debrief later, but I have compiled an answer just to show you how the answer would change in. Okay, just let me take you to the mock exam quickly again. And now it's your time to read and we'll go into the interaction phase. Okay, look at this partner email here. In this partner email, you know that you have to determine the profit on the basis, you have to determine the materiality on the basis of profit before income tax. Look at this, uh, this requirement. Using Exhibit 1 to 3, evaluate and prioritize the risk of material misstatement, and you will need to determine the appropriate materiality threshold in your briefing note. You know this requirement, right? Now, when you're writing the ROM, knowing the terminologies have changed, knowing the structure of profit or loss have changed, how will this be impacting the language when you're writing the risk? Significantly or insignificantly? Okay, let's go to exhibit number 1 and 3. I'll tell you one risk. You will read it, then I'll tell you the way to answer. Okay, I hope you're all ready. Let's open exhibit number 1. The exhibit number 1 is the partner email. So just leave aside the partner email. We have no risk in the partner email. Okay, in the partner email, it do tells us about it's a new client. It's a new client. So that information we are getting from here. But you know, it's a new client and we're writing the answer on risk of material misstatement, not on audit risk. So we're not writing detection risk at all, right? But yes, it's a new client. So there could be an additional risk in opening balances and how opening balances have been brought forward. And there could be chance of material misstatement in the opening balances if management has done any fabrication to the opening balances because we were not the auditor last year. So if you want to write that down, you can because it's a new client, but new client brings additional risk of ISA 510 opening balances and opening balances at a risk of material misstatement, provided management have done any fabrications to opening balances because we were not the auditor last year. But this is not an accounting treatment risk. We're looking for accounting treatment risk to connect with IFRS 18. Okay, let's open the background information. Okay, here is the background information just to save my time. Uh, okay, can you all read this paragraph on your screen? This one quickly. so we can link it with how IFRS 18 would impact it in terms of writing the answer? Can you just read this quickly, the paragraph in yellow, and tell me you have read it? I'll wait for your answer, right? You please tell me in the chat box you have read it. The yellow paragraph. Okay, so have you all read this paragraph? So is it a joint venture? Yes, definitely it's a joint venture, right? So they're entering into a joint venture, and it says that it's investing $5 million uh, in a newly formed company, the Aurora Company, representing 50% of the share capital. The remaining 50% will be owned by the Random Company, an unrelated company. And the contract behind this investment states that the group and Random will work together and to establish a new network. The investment in Aurora Company is likely to take place in August 20x5. August 20x5, this investment will take place. What's the year end of this company? The year end of this company is 30th of September. So that's prior to the year end, right? So we need to recognize this joint venture into a balance sheet and P&L. Now, the way you will be writing the answer is important. Look at the answer I wrote, bringing the changes of IFRS 18. Okay, can you just read this answer I wrote here? And I have determined the materiality. So if you want to read the materiality paragraph first, you can read that. Can you just read this materiality paragraph first? And I've used the word profit before income taxes very carefully. And again, use the word profit before income taxes very carefully when writing the answer for materiality. Okay, sorry, you can't see the answer. Wait 1 minute. Okay, can you now see the answer in front of your screen, all of you? Okay, can you all see the answer right? Please read this materiality paragraph. It's not a mock debrief, but I want to make some sense with IFRS 18. Can you just read this materiality paragraph and how I use the terminology profit before income taxes instead of profit before tax carefully? Right? Have you all read this paragraph on materiality? Okay. Now we know the materiality is set at $620,000 because it's a new client. Now you go down and you read the joint venture Aurora Company, right? Can you just read the this drafting I've done on joint venture and tell me where I try bringing IFRS 18? Just read this carefully. Read the four paragraphs on your screen and then tell me I have read it. Particularly look at the last paragraph because it's an investing activity, right? Joint venture. And the share of profit or loss arising from joint venture has to be shown in the investing section of statement of profit and loss. That is what we saw in the pro forma. So if you're not presenting that properly as per IFRS 18, you're not presenting that in the investing section as required by IFRS 18. So that will disturb the presentation. That will be against the presentation of IFRS 18. And that means the profit or loss will be materially misstated because of the wrong presentation. So do you all agree there is a presentational risk as well? How you present the share of profit or loss on joint venture? You should be presenting it under the investing activity. See this. It's not classified under the investing section of profit and loss. Look at the language. This is how you have to use it in the upcoming exam where needed, not forcefully, right? It's not like you linking every point with IFRS 18. I'm just giving you uh, a lesson how to write the language. Is everyone clear with joint venture and particularly the last paragraph? Are you all fine that this share of profit or loss will go into the investing section of the profit and loss? Otherwise, the presentation would be at risk. Are you all clear? Okay. Go down, read the second situation. Okay. Read another one. I hope you can see the practice platform on your screen now. Okay, we were in the background information, and from the background information, you have already read about the joint venture. Number one. Okay. Uh, Number two is about acquisition, which is a non-adjusting event. So non-adjusting event has nothing to do with the profit or loss, so just leave it out. Okay, read this. Read this one. This can also be connected with the language of IFRS 18. Can you just read this out? The paragraph, last paragraph on your screen, which is about the government grant, quickly. Just read this government grant and tell me you have read it. Okay, have you all read it? It's fine, right? $12.4 million, right? So that is material because our materiality threshold is much lesser than 12.4 million. Now, typical situation we get in the AAA paper, that again, the problem is none of the amount received has yet been spent, and the full $12.4 million is included in the operating profit. Now, it's included in the operating profit, right? So that's perfectly right. See the terms being used by the examining team. $12.4 million is included in the profit if you look at the previous papers. Now look at the term being used by the examining team, operating profit. So none of the amount received has yet to be spent, has been spent, and the management has included the $12.4 million within the operating profit in the projected group statement of profit and loss. So can you see the change of terminology is coming in the mock exam? In the previous papers, the examining team said $12.4 million is included in the profit. Now they're saying operating profit because yes, the grant income should go into the operating section of the P&L, and they're taking it into the operating profit. Are you clear with this, all of you? But is the accounting treatment right? Should the management recognize the $12.4 million immediately in the operating profit? No. So currently the operating profit is overstated and the deferred income is understated. Now, if a student says currently the profit is overstated, it's wrong. Even the examining team is saying operating profit. And even if the examining team is not saying operating profit, you should still say operating profit. Are you getting the clarity? So it's more about using the terminologies in the paper. Just look at the example. And one very important thing, look at the amount of grant here, 12.4 million, and they've recognized it in full. Be clever. Look at their profit before income tax. How much is the profit before income tax? Look at this. How much is the profit before income tax? 12.4 million. Now, if they have recorded a grant of 12.4 million, what if they would not have recorded the grant of 12.4 million? Then the profit before income tax ideally would have been zero. How important this accounting treatment is. Look at the exact number of profit before income taxes, 12.4. And how much is the amount of grant? 12.4. and they've recognized that in full. Quite possible they've recognized to fabricate. Otherwise, their profit before income tax would have been zero, or they could have been in loss. So just look at my answer quickly. Let's to reflect the IFRS 18. Okay, we go down from this to the government grant. I hope you can see the government grant paragraph here. Okay, just read this out till here. Only till here, right? The paragraph in gray. Just read it out there and see how I have made use of the terminologies of IFRS 18 carefully. And particularly look at this line. If the grant receipt had not been recognized, the projected profit would be zero. This is important line, right? I just shown you. Okay, look at the para 2. Can you see the terminology changing in para 2? I'm saying government grant should be recognized in the statement of profit and loss bracket under the operating category. Is that important to tell examiner that the government grant would be recognized in the profit and loss, but in the operating category on a systematic basis over the period in which the entity recognized the related cost for which the grants are intended to compensate. Look at my language changing. Last paragraph. The risk is that the grant had been recognized early. Now we know the grant has been recognized early. The grant has been recognized early, so operating profit is overstated. If I use the word profit is overstated, I'm not impressive at all. But I say operating profit is overstated and the liabilities are understated. Moreover, if the income from the grant is aggregated with other income and not disaggregated, not shown separately, this will be a wrong presentation as per IFRS 18, and thus the statement of profit and loss will be materially misstated. What about clubbing? What about clubbing the income from grant with other income? Would IFRS 18 like that? Would IFRS 18 like to club the income from grant and other income or shown as a separate line item? All of you, are you understanding the red line? Should we present the income from grant as a separate line item, rather clubbing it with other income? But if the management has clubbed this with other income, will it be a wrong presentation? Will it be a wrong presentation? Will it materially misstates the statement of profit or loss for the wrong presentation? So, are you getting the sense of how the IFRS 18 can be linked in your answer? How can you use the terminologies? Even in the mock exam, they're using the terminology operating profit and grant, profit before income taxes. So the terminologies are being rightly used in the mock exam even. But even when you are writing the answer, you need to be very careful of writing the proper terminology, not the word profit, but operating profit. Telling that what if the income from the grant is clubbed, with other income, it will be a wrong presentation. So you can add such points to tell your marker that I was well prepared for IFRS 18 and the changes. Okay, just one last thing to cover this up. Let's get back to the mock exam. We have read the two paragraphs. Okay, just close this out. Let's get to this exhibit 3 in front of your screen. Now, in terms of the exhibit number 3, okay, look at this. Can you just read this favorite area of the examiner, which is about impairment from here till here? Rather, it's going on the next page as well, right? So If you can just read from here till here for the time being. This is the last exercise, right? We're doing on how the change of terminologies will impact your answer. Can you read this paragraph in front of your screen in yellow? The IFRS 18 article is on the SPR technical articles. You have to download it from there. I'll share it in the WhatsApp group after my session today, if anyone needs it. Yeah, can you just read this yellow paragraph about impairment quickly so we can connect with IFRS 18, the terminologies? And once you've read, please tell me you have read it. Okay. So has the management carried out the impairment review? Quick answers, please. Have the management carried out the impairment review? Yes or no? Yes. So is that the right accounting treatment? Fine. But let's see, have they done any mistake in determining the recoverable amount? Now, in the recoverable amount, the carrying amount is $5 million. That's prior to the impairment. Fair value less cost to sell is 0.75 million. And the value in use is 3.8 million. Impairment loss recognized is 1.2 million. But we need to see the accuracy of this loss. It could be more than this because there are two components, fair value, which is an estimate, and value in use, which is an estimate. And you have to use the discount rate for present value. So there are a lot of estimations going in, which can be at risk. And the impairment loss could be more than $1.2 million. But at the first go, the management has recognized the impairment loss. That's good. Now tell me one thing. Look at here. Uh, Look at this. Can you just read this value in use, how the value in use has been determined, and tell me, is this right or wrong? Can you tell me this green paragraph? Is the value in use right or wrong, the way the management has calculated it? The green paragraph, right? Okay, Patrick, that means you have done the mock exam. Javeria, that means you have done the mock exam. Quick answers, it's wrong, right? Hira, thank you so much for that wrong answer. Uh, the value in use is estimated based on the future sales which would be generated if the damage to the building is repaired. Is that wrong? We have to take the buildings in the present condition and present state, not if they are repaired and the new equipment is put in the club. No, we have to take the value in use based on the future sales that will be generated from the club in its present condition today. In the present condition today, right? But can we take the repairing into it? The new equipment will be added to the club. No. So have they determined the value in use wrongly? Are they taking the value in use at the present condition? We have to take the current situation of the club, right? To determine the sales you will get from it, the future sales you will get from the present condition. And then you have to use a discount rate for the present value, right? So they have done it wrongly. So does that mean this $1.2 million could be under or overstated? Probably understated because they've determined the value in use wrongly. So that's the risk, right? Now just let's go and see how would you be presenting this under the terminologies of IFRS 18. Just let me show you the answer I've written for impairment. Can you just read this paragraph on impairment I have written? Particularly look at the red part I've written. Look at the red part and just read this impairment drafting I've done for 3 marks. Your time starts now. Read it. Look at the yellow and red carefully. So did I use the word operating profit would be overstated, or operating profit would be overstated rather than saying profit? So you have to be careful about the profit terminology you are using in writing the answer, because profit comes almost in every answer you're writing, because profit is understated, profit is overstated. Be very particular. Even the examining team made use of the word operating profit very carefully when they were talking about the government grant. You have to be careful. And what about the red line? Should the impairment loss be aggregated with administrative expenses? No. The impairment loss should be shown as a separate expense item under operating expenses, not to be aggregated, rather disaggregated. Otherwise, the presentation of the P&L would be wrong and it would be materially misstated. So can we write statements like such about presentational issues, aggregations and disaggregations in the last, to impress the marker that we know IFRS 18, we know that impairment loss is to come as an disaggregated expense, not as an aggregated expense. So are you all clear on how your answer for audit risk and ROM will change? It will only change for terminologies. You can think additionally about whether the expense should be aggregated or disaggregated, just like we thought in impairment, or just like we thought in government grant, the income from the government grant, or just like we thought in the joint venture, that it has to be shown separately. So are you clear? I will be sharing this answer with you, though I have to do the mock debrief yet. But because the amount of answer I've discussed with you, I'll be sharing so that you can take this as a printout and use as your reference to writing the right answer in line with IFRS 18. Is everyone clear? Will you be watchful of not using the word finance charges, rather using the word interest, not using the word distribution, rather using the word selling? Please be very watchful of that. Mohammed, it's pretty simple, right? Because impairment is a unique expense, right? Impairment cannot be clubbed in administrative expenses. We just read that in the presentation. Impairment, even in the performa, was shown as a separate line item, because impairment is not sharing its characteristic with other expenses, right? It's a unique expense, it's a one-off expense, it's a very unusual expense. So we have to mention it separately. The journal expenses, the admin expenses, that is something you can club together. No, there will not be any 3 additional marks for the disclosure risk. Yes, but you can get 1 extra mark for professional marks. So if you are writing about the presentational risk of IFRS 18, I would say it can add up to your professional skill marks. It can enhance your professional skill marks because you're trying to relate it with the presentational risk of IFRS 18. So instead of 3, you can get 4, but that is professional. 3 technical, 1 professional. Is that clear? So, but please ensure you write such paragraphs where possible. And I hope you're all fine with the changes which has been brought in. I hope you're clear with the mock. I've shown you the mock exam, right, in terms of how the terminology has changed in the partner email, how the examining team is changing terminologies in the financial statement extracts, and so on and so forth. Right? Just one last example with all of you and then leaving you off this session. Okay, just one exercise I would like to do with you. Can you just see this small example on your screen, all of you? Just let me ensure that this has been shared with all of you. Okay, yes, it is. Can you see this small example in front of your screen on a Word file? Okay, if you can just look into it, I'm giving you 5 minutes. If you can just read this uh, scenario and look at the requirement. Look at the requirement. any of the requirement, right? It's the same answer. This is the last testing of IFRS 18 so that you're all clear. Okay, have you all read it? So we have an investment property, and as part of the investment property, it is of $15 million, and the company is going to appoint an expert to value the property. Going to. Have they already appointed it? Have they already appointed it? No. They are going to appoint it. An expert to value the property. And an initial estimate of the increase in fair value of $2 million has been included in the company's financial projection. Now, have this $2 million come from an expert? No, because expert is going to be appointed. But I think the management has done their initial estimate. This initial estimate has come from the management of $2 million, and management has already included this $2 million in the financial statements. That is the changes in the fair value coming from investment property. But expert is yet to start work. Look at this word is going to. This is important, right? So, what is the risk? What is the matters you consider in a question on evidence? It's the same answer, right? You know how you write audit risk is the same way you write the matters in the question on evidence. See my answer. The $15 million invested in the plaza represents 12.5% of the total assets. So we were given the total assets here, right? The total assets were $120 million. Now that's the old approach of materiality. Now in question number one, you determine the materiality. And mostly in section B questions, examining team has started to give the threshold of materiality, like materiality is $150,000 or materiality is $100,000. They have started giving that. If the materiality is given, you will use that. But if it's not given, you know this is an approach also which comes in section B, that you have been given the total assets and profit and you have been given the issue. So you're saying that the $15 million is 12.5% of the total assets and therefore material. The change in the fair value, which is the $2 million change, which is recognized in the profit, is also 14.3% of the profit before income taxes. Look at this. Look at the terminology again I've used here. Be very, very careful. We are very habitual of profit before tax, right? You have to change yourself to profit before income taxes. So $15 million is material to the total assets, and the $2 million change in the fair value is material to the profit at 14.3% of the profit before income taxes. Okay, now go down reading this. Just read these three paragraphs quickly and see how I link with IFRS 18. Your time starts now. Look at the bold sentences. Have you read it, all of you? Have you seen the terminologies in all the paragraphs across? So first of all, I use this terminology, profit before income tax. Then I use that investment property may be measured at the fair value and the gain recognized in the investing section of the profit and loss. Look at this line. In the investing section of the profit and loss as per IFRS 18. Look at this. Is that important? You all know that the gain on investment property is an investing activity. So the gain on that would go where? It will go into the investing section of the profit or loss. However, an audit risk arises from the size of the fair value gain, which has been recognized. The property was only purchased at the start of the financial year. It's written over here. The property was purchased in October 20x4 and your year end is 30th of September 20x5. So you just purchased it at the start of the year. And how much has been the increase in the fair value? It was $15 million and the fair value has increased by another 2 million. So you divide the 2 million by 15 million. So in just 1 year time, the investment property has increased by 13.3% in fair value, which is quite a significant change. So we have to be skeptical as an auditor that is it realistic or unrealistic? An expert valuation has yet to be performed. So the gain on fair value currently included in the financial statement could be an attempt by the management to improve profit before financing and income tax. Look at this. Investing activities, and right after investing activity, which is the profit total, after the investing activity, the profit total is profit before financing and income taxes. So if the $2 million is wrong and you think the $2 million is over or is overstated, then which profit is being impacted? The profit before financing and income taxes is improved, is overstated. Are you getting this point, everyone? So investing activities and followed by investing activity, we have the profit before financing and income taxes as the subtotal. So be very watchful of that, all of you. The level of subjectivity which may be involved in determining the fair value increases the risk of material misstatement. Risk is increased as the directors may hire an expert who is known to them in order to achieve a higher fair value and which will inflate the profit before financing and income taxes. So management will hire an expert which they know and he might be working in the best interest of the management. And in that case, the profit before financing and income taxes will be inflated or overstated because the fair value is to be presented as a separate line item in investing activities, and so on and so forth. Are you clear? When I'm talking about materiality, I'm talking about profit before income taxes. When I'm talking about the fair value, I'm talking about it should go in the investing section. When I'm talking about which profit will be overstated, then I'm saying the profit before financing and income taxes will be overstated. Are you all clear with this? So I hope you've got plenty of examples about how things will be impacted. I hope you're all clear on IFRS 18, the categories of IFRS 18, the 5 categories, the subtotals, the operating profit subtotal, and the profit before financing and income taxes. I hope you're clear on the management defined performance measures. And I hope you're clear on the aggregations and disaggregations. So these are 3 important things in IFRS 18. You can capture the knowledge from my presentation, from my session today, the SPR article. I will be sharing the SPR article. I will be sharing this file in front of your screen. The answers I've discussed with you, I'll be sharing those with you and my presentation as well. So every document will come your way, right, in next couple of minutes. So are you all fine with the session today? Yes, in the same way, right, Hassan? Uh, the IFRS can come in evidence question, IFRS can come in reporting question. You simply should be knowing about the basics of IFRS 18, right? About presentation, about classifications. So there could be some wrong classifications in a reporting question, a wrong presentation in a reporting question. So you should be very watchful of that, right? Joseph, I will be doing the mock debrief session in the next couple of days. Already my question number 1 is ready. I'm just working on the question 2 and 3. So expect the mock debrief by 21st, 22nd would be available. So have you all got any comfort level on IFRS 18? Uh, 1.5 hour before and 1.5 hour later, when you joined the session, and now when you're exiting the session, have your perspective of IFRS 18 is better. Okay, thank you so much, all of you, for taking your time out and joining in. If you still need any advice on IFRS 18, you can still contact me in the WhatsApp group for any further queries, and I'll be sharing the mock session soon with all of you. Already, the question number one is in front of you. We discussed that, and I'll be sharing that. Thank you. Study effectively, all of you, and I hope you get success in your upcoming exam. Your tutor, Kashif Kamran, signing off from this IFRS 18 guidance session. Thank you.